Okay, good afternoon and good morning to some, and I hope it's not good evening for others, but welcome everyone. Such a pleasure to have you here all today. We are meeting in a kind of a hybrid mode, and we do have a small physical presence, as you can see here at Ahmedabad. Today, we have the pleasure and honor of having Mr. Injati Srinivas, the chairman of the International Financial Services Center Authority at GIFT City in Gandhinagar. And he is in charge of driving the success of IFSC, which has the remit to change the face of financial services business in India, in addition to setting up the International Bullion Exchange, where IGPC has been closely involved with the IFSC. Mr. Srinivas was formerly the Secretary of Corporate Affairs in the Government of India, where he was spearheading the committee reviewing the Insolvency and Bankruptcy Code 2016 and its implementation. Thank you, Mr. Srinivas, for taking the time from your schedule for being here with us. And a double thank you because he was able to get around the personal exigency to make the time to come here and be here in person. We also have here with us Mr. Harish Acharya, representing the Indian Bullion and Jewelers Association. He has been in the business of bullion trading for more than 20 years and is one of the top 5 bullion dealers of the country, and is also now active in gold doré refining. Mr. Harish's association with IGPC has been from the beginning, as he has been our sounding board to check on a lot of ideas. What I think one goes to him often is to get unbiased views, and also someone who is willing to try out new ideas which are in the interest of the industry. Thank you, Mr. Acharya, for your continued support. I'm glad to have you here, and look forward to the discussion with you later in the day on OECD responsible sourcing. We have also today the pleasure of having with us Mr. David Tate, the managing director.
Meghna, അമ്മ ഒരു കാര്യം മേഘ്നയോട് ചോദിക്കണം. മോളെ ഈ സൂമിൽ നിന്റെ ഫോട്ടോ ആണല്ലോ കിടക്കുന്നത്.
We have the pleasure also of having with us today Mr. David Tate, the MD of the World Gold Council, based out of London. He has a very, very unusual background, and not being able to describe all of the stuff that he's done in terms of achievement and philanthropy. And it's definitely not something insignificant when somebody has climbed Mount Everest and been in the financial services industry at the same time, and has done a lot of fundraising for social causes. He was earlier the managing director of Credit Suisse and is today the CEO of the World Gold Council. Thanks, David, for being here. It's always been a pleasure hearing from you, and we hope to hear more from you today as well.
Thank you.
Along with David, we also have Mr. Som Sundaram, who is the managing director of the World Gold Council in India, who's been a very significant presence and sounding board for us as well at IGPC. Thank you, Som, for taking the time to be here. Mr. Reddy, the MD and CEO of MCX, Multi-Commodity Exchange of India. The bullion industry has seen launch of some really interesting products from MCX during his tenure, and we look forward to more such things. We appreciate your support, Mr. Reddy, to take forward the MCX IIMA Award for Excellence in Research on Gold. Thank you for being here, albeit through virtual mode. And let me now go to our director, Professor Errol D'Souza, the director of Indian Institute of Management, Ahmedabad, who has been a pillar of support throughout in helping IGPC and giving the leeway and the scope for IGPC to do many of the activities that it has engaged in. Thank you so much, Errol. Before I call on Errol D'Souza to give us the inaugural speech, may I request the dignitaries present over here to come forward and light the ceremonial lamp. requesting Errol D'Souza, the director of IIMA Ahmedabad, to please give us his inaugural talk on this gold and gold markets conference, the annual conference that is held by IGPC at IIMA every year.
Thank you, Arvind. Pleasure to be here and with all those present. To me, it's very unfortunate that we're meeting in these types of circumstances in this manner. It would have been nice to be together in a room where we could chit chat in a very different way. But those are the times, and we have to sort of get by with it. These are times of increased uncertainty. Ever since financial uncertainty increased in the world economy post 2007, people were looking for assets which could serve as hedges and which could actually diversify their portfolios. And if you recall, just after 2007, gold prices went up at the same time as asset prices were on a downward trajectory. And I recall there was a large debate around that time about whether gold serves as a hedge or whether gold is a safe haven type of an asset. And some of the empirical work that I was also involved in, but many other researchers around the world actually spawned, was really around trying to understand this. And I recall that some of the early empirical work, I saw Dirk Burr out here. Some of the early empirical work was really showing that, say, for countries like Russia or the EMU, gold was not a hedge. Gold was a hedge, sorry, but for China and India, it was not. But it turned out that for India, gold is a safe haven asset, but not true for Russia or EMU. So interesting to see, types of differentiations that are taking place in the financial markets. There's been a growth in ETFs since that time. And it's interesting to see that both gold spots and gold futures seem to lead the ETF prices in India. And so it sort of gives an inclination that there are profitable trading opportunities out there. My sort of dip into gold and gold markets really came from a macro perspective at the time when I was working in monetary policy with the RBI. One of the things that we were concerned about was the rise in the current account deficit. And at that time, I started to work on and introduced to the government of India the gold monetization scheme. I recollect the conversations I had with the FM at that time, and in the conversation he told me that yes, current account deficit is a problem, but my problem is the fiscal deficit as well. And can gold help in solving the fiscal deficit problem? And I had actually told him a story about how gold should not be used for the fiscal deficit. And the story I told him was an economic history story that in around the year 1425 in a lovely town called Florence, this was just post the plague, and you had somehow at that time the interesting statistic was that women survived the plague more than men. And so there was a rise in a call for dowry in order to get married. Okay? And the Florentine state had entered into war with Milan and had gone into a deficit and didn't know how to fund it. And so someone gave them the idea to start a dowry fund to fund the deficit. So if you had a daughter at the age 5, you could actually lend to the state, and the state would actually give you back 10 years later your money with a fairly good level of interest in those days. If I recollect, it was something like 14%. Okay? It gave a new meaning to the term we use in finance, yield to maturity, because here it matured, your savings matured along with the maturity of your daughter. So I at that time said, not a good idea. Don't use these things. It's not good to, not only will, feminists get after you, and he laughed, but so will, it's not a good way to solve the problem. Okay. But when I think about it a little later, I found the gold monetization scheme was not really taking off for many reasons, partly because banks were not really very receptive at that time, partly the way the pricing was done. But there was another uh, product that I was involved with because for some time I also happened to serve on the board of directors of the National Housing Bank, and there I had steered a reverse mortgage policy, and even that didn't take off as well. So somehow I felt that all my policy inputs were turning out to be semi-failures. And now when I think about it, I sort of realize that there is a research theme here that somehow I don't see in people doing research in gold and gold markets, and that is about the behavioral nature of finance. When I think about it, it's really a hypothesis worth exploring. Why do people not want to, for example, eat into the why wouldn't they sort of mortgage their house and finance consumption from as they age? Uh, why would people not want to sell gold immediately when they are in crisis? Okay, and so there is really a mental accounting that is going on over here. People want to use income and cash in order to use to spend. When they run out of that, there's a hierarchy in which they sort of operate, and the hierarchy is they would then sort of after that dip into their savings into capital such as say bonds, stocks, or even fixed deposits. And then there's finally bequest capital. And bequest capital to me is both housing and gold. And that is something you touch last. And possibly to me, it's a commitment device. It's a way in which you punish yourself for trying to consume too early rather than save. And if people are doing that sort of a mental accounting, it tells us a different story about gold. It tells us a different story about asset classes. And I think it's worth exploring. It's a story that hopefully at some point when I get out of the job that I'm currently in and I have more time, I hopefully will write something about this. Okay, so it's a pleasure to be here with all of you. It's I look forward to all the talks. I see a whole host of things which are going to be talked about from the how using gold to cope from growth of gold in the loan market, and I am also interested in what David Tate is going to say as a former mountaineer myself who was on Everest and who actually at one time was on one of the peaks which was the highest unclimbed peak in the world, which was Remo near K2. I have an interest in mountaineering, and mountaineering and gold are both very risky things to be in. Okay, so thank you all. I look forward to the deliberations today.
Thank you so much, Errol, for that really intriguing talk, especially the mention of Florence and Dowry Gold. Uh, may I now invite our chief guest, Mr. Njati Srinivas, to share with us his perspectives. One would especially love to learn more about what is going on at the International Financial Services Center Authority and what are some opportunities for us here at IIM Ahmedabad, perhaps to engage even more than we already have done through IGPC with the IFSCA. Over to you, sir.
Very much, Professor Arvind. Good afternoon, good morning, good evening to all of you. We have participants from across the time zone. We have had a very good partnership with the IGPC. In fact, after the announcement by the finance minister that we'll have an international bullion exchange at the IFSC, we were keenly looking forward to a knowledge partner who could this is a very complex sector. I think Professor D'Souza has, very articulate manner, has explained that it's not an easy asset, and there are so many issues, including behavioral aspects. Also, this has been largely, or considerably, an unorganized market also has been there. So, I mean, it's a mix. And so it's a very challenging area, and there are a lot of stakeholders. So we to navigate all this and to ensure that the desired outcomes are there, we set up a working group which was chaired by Professor Sahai. And I think all stakeholders participated, and they brought out a very, very sort of informative and educative sort of report they submitted, where they have indicated the various challenges, regulatory challenges, policy challenges, which need to be addressed for this to be successful. A few words about the IFSC and IFSCA before I really get into the subject matter. India has been a little late in recognizing the importance of an international financial services center to fuel the domestic economy. But I think all the same, it has come up at a very opportune time, because today, in a way, post-COVID, we are looking at a world which will be very different from what it was pre-COVID. Even though we may overcome the damage it has done, the whole way in which economic activities are carried out, even geopolitical relationships, they seem to have changed or undergoing a change. This throws up a lot of opportunities. And India has the advantage that we are a large economy, and we have a huge growth potential in the sense that for the next 10 years or 15 years, we can continue to grow at 8 to 9%. A sustainable growth can. Then maybe we may plateau. So now the unique sort of character of this authority, the International Financial Services Centers Authority, is that it's a unified regulator. So the entire spectrum of the financial sector, whether it is banking or insurance or securities or fund management, all of them are under one regulator, one unified regulator. And there were two options. One was to have a self-contained sort of legislative backing for this authority, which could have been very difficult, because though in a way it's an international jurisdiction, it's very much a integral part of the Indian territory. And there are so many acts under which it is treated as a domestic entity. So what was done is that while there is a separate enactment for the IFSC, giving it its powers as a regulator, IFSCA has been empowered under 14 other central acts, like the RBI Act or the Foreign Exchange Management Act or the Payment Settlement Act or the SEBI Act or the Securities Act, so on and so forth. So in all the 14 acts, it actually assumes the power of the domestic regulator when it comes to regulating those financial institutions within the IFSC. And you can have one IFSC or you can have more than one IFSC. That would depend upon the viability. This is the maiden IFSC today at Gift City. So, so this is one unique type of aspect about the IFSC. And from the foreign exchange angle, it is an international jurisdiction. So that is another issue, that we still don't have full capital account convertibility in India. But here, you have a full capital account convertibility. There is another unique feature in the sense that if you look at a global financial center, then the global financial center doesn't really have to be connected very deeply with the hinterland. But having such a large economy with such huge potential, there will have to be a connect, and that's one of the reasons why this IFSC was set up. So one of the primary objects is that it will be like a gateway, for global capital flows into India, also out of India. So that is one thing, and a place where all the international financial services originating from India, they get sort of consolidated here. So that is an important aspect to this. And the other aspect is that by having, strong financial institutions, cost-effective sort of environment, and best-in-class regulations, etc., also a good tax regime, attractive tax regime, other countries may also come here for meeting their financial services requirements. So maybe to start with South Asia, then it could go beyond that also. In this context, we have already taken initial measures. For example, banking. Banking is important because they'll also play a very important role in bullion. In getting the volumes in the bullion market. So the banks, they are also now allowed to do retail business. So we have 30 million strong diaspora. Now they have a lot of net worth. If they want to open a savings account here, they can open a savings account here. Or they want to, invest in a mutual fund or something here, which in turn then invest in domestic area, that's possible. Banks in their treasury operations can also invest into India as a foreign portfolio investor. A lot of tax incentives because 10 years out of a 15-year period, you have a tax holiday. There are other tax exemptions also, which make it very attractive. In terms of the priorities, I think the bullion exchange has been an important priority. In 2018-19, for the first time, I think the government announced that we'll have gold exchanges. And in 2021 budget speech, the announcement with respect to the international bullion exchange at Gift City was made. And in the recent announcement, government is also, the finance minister has also announced that there will be a domestic exchange. So I think now the whole system seems to be getting into place where the international bullion exchange will, in my understanding, act as a gateway for imported doré and imported refined bars to enter the domestic area. Now, how this will be channelized, whether it will be mandated or whether there will be some sort of incentivization, all those issues are being discussed with the relevant authorities and stakeholders. That actually would have 2-3 benefits. One is that it would take care of the gold standards, the quality, the sourcing integrity. All these issues would get addressed to a considerable extent. And some of the difficult issues in the domestic market which are there, especially in the unorganized sector, some of those things also will get addressed. Second issue is that Professor D'Souza mentioned about, very correctly that there could be some challenges, when you are in need of money, you may not dip into your gold or, sell your house. There is a hierarchy in which you will go. But gold as an asset class also has a lot of value. It was a medium of exchange. It was a unit of measurement. It was money, and with the dollar's position also getting slightly, it is not, it's no more that unchallenged type of currency. Gold may also regain some relevance in this context. And, banks may also have gold, when they are sort of as an investment and also to diversify and mitigate risk. Here, I think unallocated gold, because in our regulatory framework, we talk about, I don't know in how many countries it is there, but here we treat gold as a financial product. For the IFSC, we say that the gold, spot contract, bullion spot contract, this is delivery based, and bullion depository receipt with underlying bullion. These are financial products. And as far as the regulations notified by the IFSCA are concerned, bullion can be the precious metal, in allocated or unallocated form. When we talk about bullion in unallocated form, then of course there will be an underlying bullion. If I want bullion to be delivered, it will be delivered. But it doesn't have to match in that sense. You just have to have a liquid market where if somebody demands. So I don't know, but I think it is something like a cash reserve ratio. I mean, the asset form, when you have these accounts or your ounces accounts, bullion accounts and all, then if you want the delivery, they will give the delivery. Otherwise, people may just keep it as an asset, and they may deal with that. So I think they may deal with that. So I think. So I think so what we are now looking at is we are looking at a phased development. The first thing what we have done is we have brought out the regulations. Interestingly, the three main exchanges in the domestic area, that is NSE, BSE, and MCX, they are coming together, joining hands, and promoting this bullion exchange. So and these are very experienced entities with a lot of technology and a lot of capacity. So we are very confident that we'll make a very good beginning, and the entire ecosystem, that is the vaulting and depository, the clearing corporation, all that also, it has been planned well, and it will come into position very, very quickly in a matter of a few months. But before actually bullion trading can start in physical delivery cases, I think it can be preceded by this unallocated trading. That will create the volumes also. It will bring in the visibility also. It will give banks a good opportunity, to do trading and hedging, even as a proprietary trade or client base to start with. And then it can be followed by leasing. Then it can be followed by spot delivery type of contract. And at a later stage, you can also look at forward futures. So all these possibilities would be there. And because it's a large country, and putting all storing all the gold in Gift City, may pose some challenges. We are exploring the possibility of having designated vaults in other special economic zones. So there are, I'm told, 500 special economic zones. So we look at those zones, and we'll see if we can have 6 or 7 designated vaults also, so that the logistics problems, etc., which may present themselves if everything has to come here, if all the refined gold which Dore imports, they'll have to come in first bring it here, it may be a problem. So those designated vaults in other SEZs can also be explored. The domestic exchanges, I think, will basically look at recycled gold and whatever domestic trade is taking place. Here, because we have, say, about 25,000 tons of gold or 23,000 tons of gold, we import about 800, 900 tons per annum. We unfortunately don't produce much gold. But if we can monetize some of this gold which is there, I think we can also address this current account deficit problem. A lot of imports also can be reduced, and it can become a very efficient, productive use of gold. Today, about 17% of GDP, the household savings is about 17 to 18% of GDP, but hardly 7% goes to the financial sector. 10 to 11% goes into unproductive investment, which is mainly land and gold. So we are treating investment into gold as unproductive, but gold is a liquid asset. And gold, if it can be, there can be so many new, fintech companies can bring in so many new financial products that it can become a very, very popular even at the retail level or, at treasury operation level, etc. Even the statutory liquidity ratio requirements also partly can be met by keeping gold. And I was actually pleasantly surprised when one of my colleagues brought it to my notice that in the IMF they have identified 4 or 5 countries where gold can be stored. India is one. So I think it's the US, UK, France, India. Maybe one more country I'm missing. I don't know. One more country is there. So that we feel that we can become the storage center of gold, for the rest of the world also, and we can become the gold refinery of the world. I don't see any reason why we can't. So because of the cost advantage and other things, and because we are the second largest consumer of gold, everybody will be happy to be in close proximity to a major consuming center. So there are a lot of these opportunities, and so therefore I feel this is one of the important priorities. There are other areas also, of course, slightly digressing with the permission of Dr. Arvind. There are some other areas also, like, for example, if you look, if you have seen the budget, 5-6 tax incentives have been given, and they are all. Sorry, I'm just concluding almost. So there are 5-6 tax incentives which have been, given to IFSC. I'll just cover them in a couple of minutes. One is that government has assured tax neutrality for foreign funds to re-domicile to India, to GIFT City. That means if funds sitting in, Mauritius or Cayman Island or anywhere, I mean Singapore, if they want to re-domicile to India, it will be tax neutral. There will be no capital gains tax, etc. So that is one thing. Second is that a lot of foreign banks, they are also investing into India through the FPI route, foreign portfolio investment route. Now they can consolidate that business in their international banking unit, which is located in the IFSC. So whether it is a HSBC or a Standard Chartered, they can all come in here. Another area which is interesting is that non-delivery forwards in INR, Indian National Rupee, this is a big business. Today, I read a IMF report about 280 billion daily average daily trade takes place, notional value of NDF, and rupees share is 50 billion. It is one of the most traded traded because we are having exchange controls. Naturally, we are a large economy, so the size is very big. So now government has done tax exemption for NDF, which is being business which is being done from gift IFSC. Today, bulk of the INR NDF is being done in London and in New York. We expect that business also will gradually come here because we have also now allowed, to be done on the ETP, on the electronic trading platform. So they don't have any physical presence in gift IFSC, but the banks can do the trading. It will be more competitive. It will be more transparent. So even this business, similarly, aircraft leasing, financing business, and alternative investment funds. So a lot of new areas also are opening up, and there will be a lot of synergies also. So I think the International Bullion Exchange will play an important role in promoting the gold sector in India, and also in improving the monetization scope, and that would and the behavior is fast changing. If you look at the millennials and all, I don't think the same sort of attachment is there. They like to change things. They don't want to have things which are carried on from generation to generation. So there are some new concepts that you could have an ornament which can be redesigned yourself. It can become 10 different designs can be there. So instead of having 10 ornaments, one ornament can be fixed and you can use it as 10 ornaments. So the rest can be as a tokenized gold bar or something. You can have a tokenized gold bar. You can have anything. So it's only a question of working on this, building robust systems, bringing in transparency, protecting the investors. I think India, with its huge household gold stock, can really benefit from this, and it can be a game changer in a way. So I think with these few words, I thank Dr. Tate to have given me this opportunity.
Thank you so much, Mr. Srinivas, for sharing with us your thoughts on what is happening at the IFSC and the IFSCA. Particularly, it was interesting to note your observations on the gold monetization scheme and the tax breaks, which will come the way of people who are interested in doing business at the IFSC. May I now invite Mr. David Tate, CEO of the World Gold Council, to share with us his thoughts on the gold market, and also to share with us. Hope that you'll be here with us a little bit more for the conference, the papers as well. I'd love for you to hear some papers. Over to you, Sir David.
Good afternoon, and many thanks to you, Errol, Arvind, and of course Sadish, for inviting me here today. I'm very pleased to be here, and thank you, Errol and Mr. Srinivas. It was enlightening to hear you both speak. However, a little bit different. In the time I have available, I would like to impart a message of aspiration, overcoming obstacles, utter self-belief, total resilience, and worthy success. And so I've been lucky enough to climb Mount Everest to the summit 5 times, twice from the north and 3 times from the south. And in 2007, I was lucky enough to climb from the north, cross over the summit and descend into Nepal, a world first by pure accident. And if anybody's interested, you can buy that on iTunes for at least half a rupee. But as you can see, I'm anything but an Indiana Jones. And so to a brief story. At 1:30 a.m. on the morning of the 5th of May 2014, I stood at a place called Crampon Point at the foot of the Khumbu Icefall, carrying a flag from Her Majesty the Queen to the summit, hopefully, in celebration of both her ascension to the throne and also those fateful steps 60 years ago by Hilary and Tenzing. I was hoping to be the first up there. The Khumbu Icefall sits at the foot of Mount Everest, and simply put, the icefall is at the point at which the Khumbu Glacier simply falls off a cliff, but in an ultra slow motion. It is vast, always moving, and the most terrifying and dangerous place on the mountain. That freezing morning, I was in the line, I was fourth in line of 6 people. In front of me, there were 2 Kiwis and a Japanese, and behind me, a Swiss lady filming for Swiss TV and a Sherpa. Over many hours, many dark hours with headlamps attached, we weaved our way over, under, and through creaking cathedral-sized chunks of ice. As the sky lightened, I arrived at a place called the Popcorn Field, which is overhung by a giant serac, absolutely vast. And despite Jimi Hendrix playing in my earpieces, I suddenly heard a terrifying scream. I looked up, and to my left, perhaps 200 meters above me, an avalanche, a huge piece of ice had broken free, and an avalanche was cascading down the mountain towards me. And in that point, I knew deep inside me that I was about to die. And it was for the first time I'd ever felt true fear. I took 2 futile steps in the snow, which was up to my knees, didn't go anywhere, and decided that I wasn't going anywhere. And so I dived behind and put my head behind a huge suitcase-sized chunk of ice. As the avalanche hit me, I admit, I screamed out loud like a little girl. I wasn't not very James Bond at that moment, I assure you. The avalanche's power pivoted me round, ripping out my right shoulder, my arm completely out of joint. I felt a huge blow on my lower right leg, and I felt a huge blow in the lower part of my back. And under the snow, in that silence, I remember thinking 3 things. The first thing was, wow, your past life really does flash in front of you like a collage, not like a video or anything or any particular pictures, but a huge flash of beautiful images that have accompanied you through your life. I also remember thinking, I've broken my leg. I'm not going to be able to get to the summit. I'm going to let everybody down at home, not least the Queen of England. And the last thing I thought was, what a stupid way to die. I waited for the crush of this snow and ice that would tell me that I was not going to recover, but it didn't come. I stood up, alive out of the snow, which is the picture you see before you now. I might look very brave, but I cannot tell you how terrified I was at that point. The 3 guys ahead of me were unscathed by the avalanche. However, the Swiss lady and Sherpa behind me, when I turned round, had gone. 2 days later at base camp, with my leg completely black and my bloodstream awash with huge amounts of ibuprofen, I was told by the expedition leader that I had a 4-hour Everest summit weather window available for me 3 days away if I chose to take it. Would I like to go? In order to get to the summit in that time, I would need to leave that night, skip 2 of the 4 camps, climb in 3 days instead of 5 days to the summit. And so I called my wife Vanessa at home on the sat phone. I explained how injured I was. I explained how difficult it would be. And she said, turned around to me and she just said, no problem. And between you and I personally think my wife's been trying to kill me for some 20 years, but she tried then as well, but off I went. Over the next 3 days, I climbed all the way to Camp 2, then on to Camp 4, the South Col, which is there, the balcony, the South Summit, the Hillary Step, the Summit Approach, until I reached the summit on the 11th of May and raised the Queen's flag over the summit. I was up there for the first summit of the year, the first Westerner. I climbed onto the summit with my Sherpas and was very grateful for being there. I must admit, having done it in 3 days, I was more exhausted than I've ever been in my life. Back in London, I handed that flag, which you see in the picture, to the Queen with my signature on it, which I found hugely amusing. And she was very grateful, and she termed my climb her royal ascent. 5 years later, I developed a few back problems. I went to see my doctor and he scanned my back And sitting next to him when we were examining the scan, he turned to me and said, "When did you break your back?" Apparently, that blow in the low of my back had cracked my spine. And so I climbed to the summit with a broken back, which sounds very glamorous, except for the fact I actually didn't know. So no heroics involved. So the message is, success is always within grasp, but often not without enormous pain and sacrifice, and so onwards. My previous investment banking career largely focused on interest rates and foreign exchange, both high participation markets that are almost perfectly transparent and trusted. It was impossible for me not to compare these markets to the global gold market where, at both an institutional and retail level, there still exists high levels of misunderstanding, opaqueness, and distrust. Many institutional and high net worth investors are still sadly reluctant to allocate capital to gold, and many retail customers are unwilling to buy the metal because of these trust and education reasons. The goal of reforming all gold markets to make them more transparent, trusted, and accessible, and hence instilling total trust, must be the new peak, the Mount Everest the entire world gold market must now scale. In this context, I chair the Precious Metals Working Group of the Bank of England, and over the last 18 months, the group has embarked on their own challenging expedition, but has made great progress in areas most people thought impregnable and impervious to change. Stakeholders from all quarters of the OTC markets have shrugged off preconceptions, ignored what was previously considered impossible, and embraced a can-do, must-do attitude for the good of the gold market. All members of this group now realize that reforms, once considered impossible to implement, are crucial to instill trust, improve transparency, and bolster participation in their own market. This group now has their own summit in sight, and with this success will come a surge in demand for gold, I'm sure. In this identical context, India has been at the vanguard of the retail gold investment program, which will transform the global retail gold market by once and for all embedding a recognized code of conduct amongst jewelers and a deep understanding of what to expect from jewelers amongst potential buyers. India's RGIP steering committee will, with the help of the WGC, navigate the no doubt often painful route to their own summit, which is acceptance of and adherence to the RGIPs. If you want to reach the summit, you will, but you must always take that next step together. The IGI initiative will not fail because India clearly does not do failure, as the announcement this week of not only tax cut, but a domestic spot exchange and regulator adequately demonstrates. You clearly have some thinkers at the core of your government. All these so-called impossible to achieve reforms will, and I reiterate, lead to greater transparency, trust, and of course, participation, from which we will all benefit. Meanwhile, the International Bullion Exchange's own Everest expedition has been racking up one success after another, as you've heard. The milestones of 2020 read off like camps reached on Mount Everest. Camp 1, February 20. The finance minister announces Gift City will set up an international bullion exchange. Camp 2, June 20. A unified regulator is announced. Camp 3, August 20. Bullion becomes a financial product. And Camp 4, December 20. Recognition of bullion exchanges, clearing corporations, depositories, and vaults. It seems to me you are now within sight of your own summit. The IBE will set the stage for an efficient, transparent, and trusted gold trading ecosystem in India, adhering to the highest standards and code of conduct. Developing an optimal trading infrastructure for gold will benefit all markets and value chain stakeholders and position India as a global gold trading hub in its own right. There will be further challenges, there always are, but much like climbing Everest is about aspiration, overcoming obstacles, and never giving up, the same is true of what you are trying to achieve in India. Keep taking that one more step, and that summit, it will be yours. Finally, and most importantly, I strongly believe the global gold market has a unique opportunity to soon work as one for common, mutually agreed goals. Global collaboration is key if our industry is to plan for and conquer the future. No one has arrived at the foot of Mount Everest alone and climbed the mountain successfully. Every single success, including my own, has demanded teamwork. Incidentally, I didn't realize that Mr. Srinivas was such an accomplished expedition leader. If he ever decides to climb Mount Everest in the future, I think there is little doubt he will succeed. However, my climbing days are over. I now prefer the warmth of a beach to snow. Thank you for the invitation to speak. I'm flattered to have been asked. Taking into account the quality of the IGPC's work, I expect this gathering to become the signature industry event, and I do hope that happens. I wish you every success going forward, and thank you for inviting me to speak.
Thanks so much, David. Wonderful to hear that story and amazed at how you managed to do that all. I'm sure it's going to inspire us at IGPC also to take many more steps than what we have already taken. May I now invite Mr. Harish Acharya, Director of Indian Bullion and Jewelers Association and Director on Parker Purchases, to give us a short talk.
Hello. Yes. Good afternoon, all. Honorable Mr. D'Souza sir, Arvind Sahai sir, N.G. Srinivasan sir, or definitely Mr. David Tate. Thank you for valuable give to speak over here. I am Harish Acharya, Director of IBJ, and behalf of Prithviraj Kothari, President of IBJ, and all the jeweler fraternity. Thank you to give a platform to speak my words for over here. Before presenting my view on International Bullion Exchange, I would like to give you a brief about the events that took the place of development in our bullion sectors. In 1996, government issued the notification to allow import gold for open general license. And the second, another breakthrough was achieved when the India First Commodity Exchange will open MCX is 2003. Third, in 2011 and 12, the government opened the opportunity to importing the refining gold ore bars into the India. In 2018, government announced the international exchange to open in Gift City. In 2019, BIS standard laid down to gold refinery. This was major leap toward the direction of the making India gold and silver bars acceptable in the world market, in the big step toward the making a self-reliant India. In 2020-21, government announced a gold exchange also. So whenever we took a small step in the direction of the developing our bullion market, we discover new options and ways of further exploring the new opportunity of further developing our bullion market. And this development process has to be further crafted by us. The opening of Indian scrap market is a revolutionary step, and government should take a step in the direction of framing such rules and regulations which can give further momentum to our already developing markets. Government, along with IGPC and IFSC, should take steps framing such rules and regulations which provide flexibility and ease of functioning to the bullion dealers and can enable Indian market to prove its worth in the international market. Government, India has import around 25,000 tons of gold past years, and thus the policies and the regulations should be framed such that it promote the trading of bullion in officially routed through nominated banks, agencies, refinery, markets, and exchanges. International Bullion Exchange will be change the perspective of the trade in the Indian markets. This will be take a step toward the market gold mainstream assets class. BIS has already established their gold standards and now steps should be taken to take over the products to the level of wherein they are internationally acceptable. Our goal will be directly competing with the LBMA products in the near future. This we should try to develop testing centers, scrap purchasing centers, refineries, and the export scrap, which are equivalent to the world and LBMA standards. One more suggestion which I would like to present before you in the introducing the bullion passbook system. This will be a system whenever all the exports and imports details will be officially recorded in the passbook, unable to develop the duly trade policy wherever by exports and imports of gold and silver possible to refine for refineries. This system should be framed such that it complies with the OECD standards. I would also like to give more humble suggestion to frame a system which enable trade and exports the enjoying the benefit of duty drawback benefits. At the present, when the export to the FTWZ, a 10% duty is charged, and when we import the return duty is only 6%, and in addition to the government change charges 1 and 1.5% governance charges on this given benefit of duty drawback is around 8 to 8.5%. Further assembly give us just for understanding. We would like to also the present this our view for the government is allowed to export the bullion framework. And I will speak some Hindi because I'm used to speak in Hindi. So please ignore my, but I wanted to talk with David Tate, so I will speak in English. Digital gold and ETF. This is the biggest requirement of right now in India. There are so many people are thinking to buy a digital gold. So हम लोग उसमें क्या कर सकते हैं कि इंटरनेशनल गिफ्ट सिटी में हम एक डिजिटल गोल्ड का या ETF गोल्ड का इंटरनेशनल प्राइस है जिसमें ड्यूटी और जीएसटी नहीं है, तो ये गोल्ड बहुत जैसे SPDR गोल्ड ऑलरेडी है जिसके पास 3,500 टन सोना है, तो हम यही कुछ हम लोग गिफ्ट सिटी में या ऐसा कुछ डिजिटल गोल्ड अनाउंस करते हैं तो पीपल लव टू बाय अ फाइनेंशियल आइटम एज अ बाय एंड सेल, और ये बहुत बड़ा फायदा दे सकता है इंटरनेशनल एक्सचेंज को भी और गिफ्ट सिटी को भी, आगे जाके IFSC को भी इसका क्रेडिट आएगा। तो मेरे हिसाब से हम लोग बुलियन डीलर ऑलरेडी ऑर्गेनाइज सेक्टर में जा रहे हैं, जाना चाहते भी हैं, और हम लोग आगे जाके अगर कुछ इंटरनेशनल फाइनेंस सिटी में अगर इंटरनेशनल एक्सचेंज प्रॉपरली वर्क करेगा तो यहाँ पे भी जो रिफाइनरियां ऑलरेडी ऑर्गेनाइज हो रही है उसमें से आने वाले समय में 5 से 10 रिफाइनरियां और LBA में भी एक्रीडेट हो जाएगी, क्योंकि आज तक ऐसी अपॉर्चुनिटी हमको मिली नहीं है। और ये बहुत शॉर्ट पीरियड में जो रेवोल्यूशन स्टार्ट हुआ है 2013-14 के बाद, और आज 2020 में कंटिन्यूस गवर्नमेंट हर साल एक स्टेप अपना आगे चल रही है, तो हमको भी एक मौका मिलना चाहिए कि आज हम लोग ऑर्गेनाइज सेक्टर के लिए प्रिपेयर रहें। OECD है और RGC है या RMI है, वो ऑडिट के लिए भी हम लोग रेडी हैं। बुलियन इंडस्ट्रीज अपना फुल सपोर्ट के साथ इंटरनेशनल एक्सचेंज को सपोर्ट करने को भी रेडी है, और आप बताएंगे उसी रास्ते से हम लोग चलने को तैयार हैं। थैंक यू very much for my side. Thank you, sir.
Thank you, Harish bhai. The success of the bullion exchange and in fact the spot exchange, the domestic spot, will be a function of the active participation by all stakeholders. So aapka participation and of other people is going to be really important. To conclude our session, let me invite Mr. PS Reddy, MD and CEO of MCX Limited, to share with us his thoughts on gold and gold markets.
Thank you. Good afternoon, everybody. Good afternoon, Srinivas Garu and Professor Sahai, Professor D'Souza, and Mr. Sudesh, and Mr. Harish, David Tate, and other dignitaries around the virtual conference room. Let me, at the outset, thank India Gold Policy Center for giving me an opportunity to speak at this occasion. As you know, MCX has been a market leader in these products. In fact, much like the days that it is the gold or it is the family silver which we use at times of need. It is the gold and silver contracts which are sailing through the exchange when the times are bad. So during the COVID period, MCX gold and silver contracts have really done well, and this exchange volume has remained as high as what it was in the year 1920, almost 31,000 crores ADT, average daily turnover, thanks to these contracts which have sailed through the difficult times. While we are happy about these contracts doing what they are doing, but at the same time, we are very keen to integrate our market or our platform with the physical market. In this direction, we have thought that so far we have been allowing only LBMA refined gold being traded on the exchange platform, but we must allow the domestic refiners also should to deliver their products on the exchange platform without compromising on quality standards. So we have gone through the LBMA standard procedure. We have under the Atmanirbhar Bharat mission of the government, we have prepared the process for India Good Delivery Standard to be adopted by the exchange. And after following the due process, we have yesterday only we have empaneled 2 gold refiners, that is MD Overseas and Kundan refiners metal to be delivered on the exchange platform. This is just a beginning. A lot of applications are still pending, and we will be doing the same process. But all the time I have been telling our partners in business, I would call them partners because we have huge stakes in this industry. We must collectively ensure that this industry grows. Now, I have been telling them, and in my interactions with them, I have specifically pointed out the trust cannot be built overnight, but that's all the time it takes to lose. Okay, and again, if you have to rebuild the trust, that is something which is maybe enormous time it takes, maybe more than double the effort what you have taken to build in the initial stages. Now, why I'm saying this is, in fact, we are a listed company, all of you know, and some of the analysts during the analyst meet, they asked me, Mr. Reddy, what keeps you awake, as a listed company and for running this organization? And I tell them the quality of the goods lying in the warehouses is something which all the time worries me, because that is something which we should always be worried about. That is something which we have to keep the process in place where that particular standards and quality as well as quantity standards are adhered to. Now, why I'm saying is there could be a lot of we are on a path of development, and in the process we understand that there could be some hiccups, but that should not deter us from doing what we have to do. So in this direction, we are also keen to participate in the Gift City, the India Bullion Exchange, set up India Bullion Exchange, as Srinivas sir has already said that the exchanges and depositories are coming together to form an India Bullion Exchange. And we are as much keen to have a domestic exchange as well, a spot exchange, as has been announced in the budget. And now, why these are very important for us? Because the physical market is not as much transparent, is not as much integrated as it ought to have been, keeping in view that we consume almost 25% of the total gold that is produced in the world. Probably that's very important that we must have a very highly integrated platform. Now, we do say that on the exchange platform, almost all about 119 tons of gold has been delivered since inception. Similarly, about 3,500 tons of silver has been delivered on the exchange platform. But these are all numbers. They may be mind-boggling for us, because for an exchange like MCX, where there's no other competition, we feel very proud about it. But at the same time, we have not scratched even the surface in this country. There is a huge scope for all of us to work in this and expand this market. That is where we are focusing on. And this gold standard, gold exchange, a spot exchange, will integrate the domestic physical market with the derivatives platform. That is what we are looking at. And we would like, as one nation, one price is something that we are looking to be displayed in every jewelry shop, that no, this is the price, and you go anywhere and the customer should get confidence that this is the way, this is the price that is arrived at in a transparent manner. Now, having said this, I would also like to emphasize, since Srinivas sir is around, and I'm sure he's also pretty much working towards that there's nothing wrong in promoting our nationalist interest of having a gold exchange, be that international bullion exchange or in the spot exchange. And to make it a success, probably certain regulatory regulatory nudge is needed for making it a success, such as, like, directing all imports to be done through the international bullion exchange. Now, why I'm saying this is very particularly my experience in the depositories in the securities market is a big eye-opener. And prior to 1996, when the depositories are not there, there's a huge bad paper in the market. There was multiple share certificates, and nobody knows what is right, what is wrong, what is fake, and whether that will go through the settlement process or not. But thanks to depositories, all that fake paper and bad paper was eliminated, and there is a huge convenience of digital transactions through the depositories. Now, that had happened only because the SEBI at that point in time forced the institutional investors, high net worth individuals, to deliver the paper necessarily in a demat form. Otherwise, people were not willing to move towards that. So the moment they forced them, then the opposite party, whoever was receiving that, has no choice but to open a demat account, and then the whole dematerialization has started. Similarly, unless that such a regulatory nudge is given, and I'm sure that should be accepted by the industry with open arms, that they should be importing, or rather they should be buying the gold only on the international bullion exchange, then automatically even the sellers, maybe international banks or other refiners, they will definitely come onto the exchange platform in Gift City and transact on the exchange. That's how collectively we can make this happen and make it as a grand success. With these words, and again, I thank IGPC. Also, some of the researchers are, I think, in the next 2 days are going to make present papers, and I compliment them for producing wonderful papers. I'm sure the IIM Ahmedabad will pick up the best paper and award the MCX prize that we have sponsored. Thank you. Thanks to all of you. Thank you, sir. Thanks to all of you.
Thank you, Mr. Reddy, for being here today with us and for sharing your thoughts. With that, we come to the end of this inaugural session of the conference, and we will now move into our different tracks for presentation of different papers. The first track is going to be on gold demand, is going to be chaired by Professor Joshi Jacob, and we have 3 papers, one by Dirk Bauer, Errol, in case you're interested, and also one on empirical efficiency of gold futures, which is by Dr. Golaknath, and new product on derivative exchanges, how they are shaping gold trade. That actually is going to be jointly between Shivanshu and Nagendra. That should be interesting. So I think we can break and go into our rooms for our meeting. Hi, Dirk. How are you? Good to see you. You're sitting in Perth? Can't hear you. Voice is still not coming.
Can the IT? Yeah, thank you.
Oh, now it works. Thank you. Yes, thanks. Thanks so much. I'm in Perth, and we had a short lockdown, but it will end in 15 minutes. So it was rather short here. Thank you for the invitation to present. I'm happy to present this joint work with Bala and Sanket, two professors at Indian universities. And I'd like to start not with a Mount Everest story, but with this coin, which is very, very valuable. And this was stolen from a German museum a couple of years ago. Here you can see the article, The Bumbling Thieves Who Stole an Enormous 4.3 million gold coin from a Berlin museum and probably melted it down, are heading to prison. So this is, of course, not what I will not talk about stealing things, but I thought I'd start with another example of demand for gold, and also one feature that is also mentioned in the famous James Bond Goldfinger, that it is easy to hide your tracks by melting it down. That's what they did. That's why it was pretty hard to find them and put them in there. So anyway, let's go back to stuff that is not about stealing. So the motivation for this paper is, what are the drivers of gold demand? What are the variables that determine it, influence it? Then another related question, is all gold equal? So all types of gold, for example, is there a difference between bars and coins and jewelry and gold ETFs? You may say, of course it is, but what are the differences exactly in relation to the drivers? Then is jewelry demand decreasing in favor of other forms of gold? Is it decreasing at all, given that we often hear that jewelry is maybe not the best form of gold as an investment? That's at least what people are told in other countries, maybe not in India. And then how has the introduction of ETFs in 2003 changed the demands for other forms of gold? And is there then even something like a financialization of gold? And then another question that is interesting, I think, are there differences between countries like Australia and India, or countries like US, Europe, and middle-income countries in general? So that's what we want to address. And I think it's relatively, it's a clear question, it's simple, and I'll try to make it as easy as possible. So it's easy anyway, because I present you a couple of graphs first. So gold demand trends, which are sourced from the World Gold Council. So here we have the trends in gold demand for all countries. The black solid line is jewelry demand, and you can see a slight downward trend. You see a upward trend in the demand for bars and coins. And you also see, it's not so clear, the trend, the dashed line, the demand for gold ETFs. What is clear is that the demand for gold ETFs is rather volatile, which is consistent with the idea that financial assets are volatile, or we know that they're volatile, and that the risk of financial assets is a core feature. So it looks not exactly the same, a little bit different for high-income countries. If we separate this global sample into high-income countries, so then here you see a clear trend in jewelry down, relatively stable in bars and coins, and for ETFs you see a strong initial rise from 2003, but then again that volatility is still there. And it's very different for middle income countries, because here there's no trend, no downward trend as for high income countries in the jewelry demand. There is a clear upward trend in bars and coins, and the gold ETF demand is rather low. That seems to be something that is more available in high income countries and middle income countries, and the demand is rather diminished. So summary, jewelry demand down globally, but not in middle income countries. So there's still there's an interesting difference between high income, middle income countries, despite globalization and claims that we're that there's a convergence in preferences and we're all becoming more equal. Bars and coins are up in general, and ETFs are also up, but comparatively volatile. So now, what is driving the demand and changes in the demand? So that's the key question and the contribution of this paper. So the outline of what I will do in the remaining 10 to 15 minutes, I give you an overview of the data that we use, the model, the estimation results, summary, and concluding remarks. Keep the model relatively high level, but present you the full results. So we have cross-country annual data on gold demand obtained from the World Gold Council. We have 30 high-income and middle-income countries, so specifically 16 high-income and 14 middle-income countries. The focus on demand for gold by retail and institutional investors, that's what our focus is on, and we excluded the central bank demand. The sample is from 1996 to 2018, and the ETFs, they only are available from 2003 onwards. And the other variables that we are using to understand the drivers of gold demand, such as global uncertainty, gold prices, and so on, they're sourced from the World Bank development indicators and the FRED database of St. Louis. So here are some examples. The jewelry bar and coin ETF from the World Gold Council, then the GDP of a country. From the World Bank, we have private credit scaled by the GDP of a country that we use inflation, because as we know, gold is thought to be an inflation hedge, even though there are several studies that put some doubts into that idea, at least on a global scale. Then we have the logarithm of the really effective exchange rate of a country, the log price, and the VIX as a proxy for global uncertainty, or specifically implied volatility, which is a proxy for global risk or uncertainty. Good. So for the econometric model, the problem is that, well, the problem, or something we address explicitly, is that the demand for various types of gold, the types of gold are jewelry, bars and coins, and ETF, can affect each other. And then there's some simultaneity here. So, for example, the demand for jewelry may increase simultaneously with the demand for bullion. And if simultaneity is not accounted for, the results may indicate that the demand is rather large, while in fact it is much smaller. So gold demand types may increase or decrease simultaneously if they are driven by certain factors. For example, if high inflation leads to affects both jewelry and bars and coins, I mean, then not accounting for that could also indicate that the two are highly related, while in reality they are not, because they are driven by another factor, and if that factor is not explicitly modeled, then it may look as if jewelry and bars and coins are related, but they are less related or not related. And how do we do all this? How do we account for this simultaneity? We use a three-stage least squares approach, and that models that controls for this, for the fact that these variables are and demand is endogenously determined. This is essentially, you have to think of three equations. So we have three gold demand characteristics: jewelry, bars and coins, and ETF. And we have three equations where we model this. We assume, of course, that jewelry is dependent on, or we allow that the jewelry demand is dependent on the bar and coin demand and ETF demand, and we have the controls that, for example, inflation can be a control or a factor that potentially influences it, as I just explained. And the same then for bars and coins, which then is related to potentially to jewelry and ETFs. Also, the controls, the same controls and ETFs are related to bars and coins and jewelry potentially. Good. So I present two sets of results. We do that also in the paper. First, jewelry and bars and coins, like we only model those two equations and leave the ETFs aside for initially, and then in a follow-up on the second stage, we use all three and then estimate all three equations. So this is a table from the paper. It looks busy, I know, but I'll zoom in and tell you what that means. For example, here, the first equation in the first column with estimates, we have that's the jewelry equation, and these estimates tell you that bar and coin demand positively affects jewelry demand here. It's not, the coefficient is not 1, so there is a small effect, but it's significant. And also that the second equation, which is here, the 2 stands for bar and coin demand. So here jewelry demand also affects jewelry demand. So there's a both affect each other on if we use all countries. But it's very different when we look at high income and middle income countries. So when we just use the high income countries, then there's no such relationship. So it seems that those two variables are the demand for jewelry and bar and coins is independent of each other in high income countries, unrelated. Whilst there is no such independence or segmentation for middle income countries, where here you see that the demand for bars and coins has a clear effect on jewelry demand, and also the jewelry demand has an effect on bar and coin demand. So here clearly a difference between high income countries and middle income countries. And you also see, I think it's also very interesting, maybe not surprising, but we are not aware of anyone who has shown this explicitly, that again, that first equation is the jewelry demand, so that here the price, there's a negative relation of the price with jewelry. So the price goes up, the demand for jewelry goes down. If the price of gold goes down, the demand for jewelry goes up. And for bars and coins, the relationship is positive. So here, if the price goes up, the demand for bars and coins goes up, and if the price goes down, the demand for bars and coins goes down. So it's very different. And when you think about it, the jewelry, then like this negative coefficient is more consistent with a typical or normal consumption good, which may also explain why we often call that jewelry demand gold consumption. Even though in many cases you don't really consume it, you don't eat your jewelry. That's why I think that the consumption is a little bit misleading, because that gold will never disappear, while or will always be useful to some degree, and it's not very different from investment in my view. Unlike if I buy a TV or a car, I can use them for, I may be able to use those things for quite some time, but they will be useless at some stage, most likely. So anyway, this is more like a normal consumption good, that negative relationship, and it's positive for bars and coins. And we can see there are also slight differences. Again, here for middle-income countries, that's very, very strong, and it's not really there for high-income countries. And then we can also look at the VIX, so that implied volatility or measure for global uncertainty. And here we see that, maybe not surprising, but it's quite neat how we find these things and can identify these, that the VIX, the changes in global uncertainty seem to have a strong impact, a highly significant impact on bar and coin demand in high income countries, but not in middle income countries and not on jewelry. It's very intuitive, but I think it's nice if empirical analysis can identify these things and clearly show differences between bars and coins and jewelry. So, quick note on the econometrics, or what could possibly go wrong. If I can just highlight quickly what the difference is when we use this 3-stage least squares, where we control for the endogeneity, for the simultaneity, that the jewelry demand affects bar and coin demand and the other way around. So if we didn't do this, this is what I presented to you here on the left-hand side, the three-stage least squares, the correct thing to do. So the incorrect thing, which is maybe not so clear because it also looks nice, right? I could tell you that this is actually correct, but it's not, because here we do not control for this endogeneity, for the simultaneity. You see that the coefficients are much larger here in the not correct one. Okay, so this is why I thought I introduced this as what could possibly go wrong quite a lot. Okay, and then here, if you like here for the all countries, you have two effects, but for if you look at the differences between high income and middle income countries, you may then find stuff that is actually highly misleading. We don't do this. We show here, I clarify here that the OLS not accounting for this is incorrect, and you can see that there are big differences. So now we, the second stage, we include the ETFs and now model 3 equations. And when we do that, so now I focus in that we have less numbers here. We see that the jewelry, bar and coins here, no relationship, very strong relationship here for middle income countries. The relationship between middle income, between jewelry and bars and coins in middle income countries and high income countries. That's what you see here in the red circles. And focusing on ETF demand, when you look here, high income, it seems that the third here, equation 6 or column 6 is the ETF demand that is modeled here. So we see that jewelry demand and bar and coin demand have a strong influence on ETF demand in high income countries. But you see, not surprisingly, perhaps because the ETFs are in a sense underdeveloped in or less popular in middle income countries, there's nothing like that in middle income countries. Good, we find more, but this is just an idea that you see that what we do and what we find, and that is quite interesting, I think. So here, summarizing what we find, paper focused on 3 types of gold demand: jewelry, bars and coins, and gold-backed exchange-traded funds from 16 high-income and 14 middle-income countries. The econometric analysis shows that the factors that determine the demand for each of the 3 types of gold differ both across types and across countries. Big differences between these types of countries. And jewelry demand is negatively affected by gold prices and immune to global risk changes. That's the VIX influence here. Jewelry demand very different to the others. Bars and coins positively affected by gold prices and not immune to global risk changes, so clearly affected by it. We can also derive that jewelry is acts as if it was a normal consumption good, while bars and coins rather act as a financial asset or typical for what we would expect from a financial asset. High-income countries display different demand characteristics than middle-income countries. So larger demand for jewelry in middle-income countries than in high-income countries, and jewelry and bars and coins are unrelated and segmented in high-income countries, no relationship, but positively related and not segmented in middle-income countries. Conclusions. The analysis that we do in this paper provides important information about the role of gold for different income levels and for the usage of gold. For example, something that I haven't said is like we could, what we mentioned in the paper is that if in middle-income countries jewelry is much more popular then and preferred over bars and coins, it is possible that in middle-income countries people would pay much more for gold because there's higher margins on jewelry in general than on bars and coins, and it's clearly more expensive to buy these 2 types of assets than ETFs. So it seems in terms of investment, high-income consumers or investors potentially get it at a much better price than consumers or investors in middle-income countries. Another conclusion here, formulated as a question, is gold used as investment and thus influenced by global risk factors, or is it rather used as a store of value and thus mostly unrelated to global risk factors? So there's potential also for more research to distinguish store of value, then you wouldn't expect that it's highly related to global risk changes, while that would be the case for gold as an investment, bars and coins, for example. And then gold demand and gold demand drivers are very different across types of gold and across different income levels of investors and of investors and consumers. All right, thank you. I'm not sure if I should stop sharing.
Yeah, thank you, Dirk. Actually, Joshi, who's supposed to chair the session, Joshi Jacob, he's not here. We can take some questions from the audience. It is a very interesting presentation. I mean, I'm a co-author, so I'll obviously say it is interesting, but
yeah,
it's so we can.
And it was your idea, Sanket, right? So I just had the pleasure to present this today. It was your idea to do this analysis and this research.
Thank you. Yeah, there's a question from Mr. Somsundaran.
Yeah, I just wanted to understand when you say middle income and high income, obviously I guess China and India diverged. China might have gone into high and India into middle income. Question was, if India is removed or if China is removed, because these two are giants in their own way, if we take this out, will these be any different? Because they have their own dynamics. I'm not saying these don't apply to Indians and Chinese consumers, but I still think that these are two deep markets and there are several factors at play. What are the other countries, how would it look like? Would the same conclusions stick?
It's a very good question, but I don't have an answer because we use this panel data, and I mean, that's always the issue, right? When you look at many countries, you get some average effect, but then of course you don't know automatically what like how similar India is or China to these average results. But it's a very good question. I think we should look into this. Maybe Sanket or Bala, you have done this aside and never told me about it because we don't have it in the paper, that specific analysis for India or China. Do you have any comments on that?
Well, I mean, we treat all countries equally. So in a panel data model, we are not weighing it by the gold consumption or the amount of gold that they're using. So each country is treated as just one unit.
Okay.
So we are treating India the same as we are treating the US.
But we could do also individual analysis, couldn't we? I mean, we could maybe say, okay, because India is so important, because two of the co-authors are based in India, and China and India are giants, that we do this analysis maybe also for those two countries separately, and then maybe just discuss what we find, right? Are they, like, how similar are they to the average?
Yeah, I think that would be very interesting. So we can extend the model to look at India and China specifically, as well as the other countries which are how they behave differently from India and China. So we have another question from Maria Emanuel. Can I request IT support to unmute Maria? Maria, are you there? Maria, can you type your question on the chat window if you're on mute?
I think she needs to be unmuted, and I think that's the problem. It looks like IT should be able to do it. Otherwise, we could ask Maria to just at least write down the question. It'll be interesting to know what the question is.
So Maria, can you just write down the question, please, if you can? I have requested IT support to unmute you, but seems...
Yes, sir. Good afternoon, Emmanuel here.
Okay, please go ahead.
Yeah, I have one clarification on the results that is shown on the PPT. If so, there we may find a contradiction what Somasundaram sir asked the question. So if you go to the data, the results of your first slide. So there you have given the GDP results, and you find significant for all the countries whereas it is not for the high income as well as when you're separating the data into high income and middle income, it is not there. So can I, based on the results, can I assume that middle income countries are consuming more than the high income countries? Yes, yeah, this is the slide. So if you look at the log GDP, it is significant for all countries. And it is not significant when you are separating the data into high income and middle income.
Yeah.
Just by looking
But
at the data, can I assume that middle income countries are consuming more than the high income countries? So what is your opinion on this?
Well, I mean, it seems that the coefficient, the signs of the coefficients are always the same, right? So we have GDP positively affects the demand of the two types in all countries. It's just not significant for when we separate them, which could be an issue that we just don't have enough power then to identify that. If you think that, I guess your question also means like, is the 18 the coefficient for jewelry, that it's much larger than for high income countries? Does that mean that they consume more? I wouldn't say that they consume more, but I would say that whenever the GDP goes up, so if the country is in a boom, that then the effect on jewelry is much stronger in a middle income country than in a high income country. Right? So it's not a level thing, but more relatively, if there is strong GDP growth, then the effect on gold is much stronger in middle income countries than in high income countries. I think we can derive that from this result, particularly clearly for jewelry. For bars and coins, there's doesn't seem to be clearly not statistically significant, the difference between the 6.17 and the 6.04, right? So but it's a good question because it also highlights that, again, there's a big difference between high income and middle income countries with respect to GDP and its influence.
Because the objective of buying gold in India may not be the same what you find in the other countries. So maybe if you are trying to address country-wise analysis, maybe this could be add more value to the paper. Yeah. Thank you, sir. Thank you so much.
Which is easy. I mean, if we go into that we look into India and China, then we run that model just again, and we see that whether there is some clear differences there. Yeah, good point.
Yes, sir. Yes, sir. Good. Thank you.
Thank you.
Any other question? So there was a question on the chat window on. Thank you for the presentation. Do you? I think, do you need this coefficient? Do you think these coefficients are statistically significant to derive the conclusion? By Hiren Chandaria. Hiren, can you speak up? Can the IT unmute Hiren?
Is she, or the question is based on that, what I just said, that the coefficient, the 18.44 is not significant. Is that the question?
It seems maybe I'm not sure if it's related. So I'm requesting Hiren to please type out the question. Hiren, can you please type out your question, or
Professor Sakit, I think IT, it's only panelists who have been listed as panelists can actually speak. The rest have not been able to speak. Maybe when we take up question and answers, if it is possible, we should ask IT to open up for everybody. But
yeah, I think that's a good
idea. Put them on mute, but ask everybody so that it can be more interactive. But
so I'm requesting IT to unmute everyone.
Which sometimes leads to a lot of noise, right? But let's hope not.
Okay, I think Hiren is not there. Any other questions from the audience regarding the paper? Okay, I think IT should be. I don't know if they have the ability to do that, but I don't see any other questions in the chat window. So I think we can move on to the next presentation. So thank you, Dirk, and thank you, Mr. Somsundaram, for the questions. So we have a presentation by Golaknath, Vardhana Pavaskar, and Manuel Pacheco on the empirical analysis of efficiency in the Indian gold futures market. So we'll go on to the next presentation now.
Yeah, Manuel, can you? Yeah.
Yeah, please go ahead. Manuel, we can't hear you.
A very good afternoon to everyone here. Am I audible now?
Yes, we can hear you now.
Yeah, a very good afternoon. So our paper presentation for today is an empirical analysis of the efficiency in the Indian gold futures market. It's presented by Dr. Golaknath, Dr. Manoj Dalvi, Dr. Vardhana Pavaskar, Ms. Sahana Rajaram, and myself, Manuel here. So the objective of the study is essentially to look at the relationship between the domestic spot market price and the international gold spot market price. We further look at the relationship of the domestic prices with spot prices with the futures market prices. So further, we look at the direction of information flow between these markets, the spot to the futures market and vice versa. We try to break down this relationship into a long run and short run process to try to analyze what the price discovery or efficiency of these markets are, in essence to determine where does the price discovery really take place. To conclude, what we do is we look at the futures market in India and see if it is an effective hedging instrument or a hedging tool for the underlying spot markets. Literature has briefly covered the analysis of price discovery in the gold market and in commodities market in general. It is still scarce, though they do find some sort of relationship between the spot and the futures market. What our paper does, in essence, and our contribution to the existing literature is it looks at certain policy changes that take place, that has taken place over the last 10 years. And see the relationship in each policy regime. We also look at multiple spot prices. So in addition to looking at the MCX spot price, we looked at the spot price, which is essentially got pulled from Reuters. And as these are the two domestic spot prices which are considered. For the international spot price, we looked at the price from the World Gold Council. In addition to this, we looked at the returns and variance of both the series and see the relationship of whether the variance in one market does impact the variance of the other. Our data specifically has been MCX spot price, which is an indicator of the domestic market price. The ex-Ahmedabad gold spot prices were considered the afternoon prices. Reuters spot, the same. World Gold Council as an indicator of international spot. For futures prices, we looked at three tenors, the near term, that's the 1 month, 2 months, and 3 months futures contracts that are traded on MCX. So we derived the data from the Reuters terminal at that time. We considered, since we're talking about prices, we looked at, we transformed them into natural logarithm. So log transformation of prices were done. And we had an extensive 10-year period from January 2008 to March 2018. A preliminary analysis of the ratio of the MCX spot price, that is essentially an indicator of the domestic spot price, with the World Gold Council spot price, tells us that there was a deviation, specifically or a break in the pattern and the relationship that happened between 2013 to 2015, and we'll come more to that as to why that happened. But primarily, it was the time where there was we suffered from a current account deficit crisis during that time. So there were a couple of initiatives that were taken to curb the price of gold, specifically in relation to taxation. The custom duty and import duty taxes was gradually increased. So also there was a 80-20 rule that was implemented. So there were restrictions on the import of gold that took place. So the results, what we carry out, indicated and revealed that there was a deviation from a regular trend, what we noticed during this period. So having said that, we looked at the sample as a whole, and we also broke it down into 3 distinct periods. The first being January 2008 to May 2013. The second from June 2013 to May, that was essentially the tightening phase that was accounted for. And the remainder period of June 2015 to March 2018. A look at the data in level and first difference does indicate that the mean and of the spot price with that of the futures price were kind of, the returns were kind of in sync with each other. However, the second moment, third moment indicators like kurtosis, skewness did indicate a slight divergence between domestic and international spot price. So the behavior was slightly different. So our main observations from our preliminary data description revealed that the mean of the series was similar. Second moment, standard deviation was also similar. Third moment, skewness, kurtosis, fourth moment, kurtosis were different for the 3 spot prices considered. Pearson's correlation as an understanding of the correlation between the various domestic spot prices, international spot price, and the futures prices indicated quite a high correlation, 0.99 significant correlation for the full period, for the first period as well. For the second period, that is the problem period, essentially we see that there was a deviation between the domestic and international spot price. The correlation number dropped to 0.77 on an average there. So this was a bit disconcerting at that point of time. It talks about the same, hence it warrants a breaking up of the period into 3 sub-sample periods. To look at the study and of the relationship, we started off by testing the stationarity. If a series is non-stationary, it could have impacts on the results. So hence, stationarity was a precondition. So we looked at the test for stationarity at level and first difference. Co-integration is also an important tool to analyze a long-term co-integrating trend or a long-term relationship between the 2 series in consideration. So if for whatever reason the series is not co-integrated, then a VAR model is kind of sufficient. That's a vector autoregressive model is sufficient to estimate the relationship in a lead-lag framework. However, if in case of a co-integrating relationship between the variables in consideration, Vcm model is something that we have to look at. So that's what we did. So we looked at a vector error correction model as well. Based on the parameters from the Vcm, we could also, estimate the weights of the 2 series in consideration, the futures and the spot prices. And using a Gonzalo-Granger common factor model. So it tells us which variable was more important or in driving the other. So in the lead-lag framework towards this long-run relationship. Further tests that were conducted included an impulse response function, error variance decomposition. In addition to looking at the returns, we also looked at the variance of the series. So we wanted to see whether the futures market is an effective hedging instrument for the spot, be it domestic spot or an international spot price. So we estimated what the optimal hedge ratio would look like. And we also looked at unhedged portfolio and a hedge portfolio using the futures prices in the portfolio, and tried to understand whether adding futures would essentially help in effectively reducing the variance or improving the hedge. And does this play the same on the domestic as well as international spot price? So our results essentially indicated that, and the numbers are given in the annexure, and we can definitely go through them, that the stationarity test, the stationarity results indicated that the series was in fact non-stationary at level, but stationary at first differencing. So therefore, we looked at the return of the difference in the series at 1%. We also found, using a Johansson's co-integration test, we found that the co-integration, we found a strong co-integrating relationship between the domestic spot price and the futures price when the full period was considered. We did, however, find a weak long-run relationship between the international spot market price and the futures price when the full period was considered. The co-integrating relationship, looking at it from a period-wise breakup, indicated that the domestic spot and international spot in the first period and third period were significant. The co-integrating relationship was significant, but not in the second period. This essentially, tantamount to certain regulatory changes that were initiated during that period that had weakened this long-run relationship between the domestic and international spot price. So estimating the Vcm model in the to estimate the long run and short run parameters, we have put up a brief description of the direction of information flow in a lead lag framework here, and it tells us very intuitively that for the period as a whole, we did find that the futures prices do influence the spot price to a great extent. In our case, we find a bidirectional relationship for the spot price also does impact the futures prices. But when we did look at it from a period-wise perspective, it indicated that during a relatively calm period when there was no major regulatory changes, the first and the third period specifically, the futures price was an influencing factor to the spot price. More often than not, it was always the futures prices, the futures market prices that were driving the spot market prices. This was applicable for both the MCX spot, the Reuters spot, both being indicators of domestic spot prices, as well as the World Gold Council spot price, an indicator of the international spot price. The same applicable for the third period. In period 2, what we did see was, given that there were changes that were implemented to the spot market, restrictions imposed in the spot market, changes in the spot market did influence the futures prices. So there was a correction of futures prices based on the correction of the spot market. That's what we essentially highlight here, that except for period 2, the daily price discovery process in the gold market ideally takes place in the futures market and not in the spot market. Period 2, the restriction imposed did have cause an impact in the dynamics of the relationship between futures and spot prices as well. The futures price does help in in the price discovery process. Primarily, what we could attribute it to is that the information in the futures market is available on a real-time basis. It's an actively traded market, especially the near term, the 1 month or 3 months in certain cases. The domestic spot price is a polled price from a select group of market participants. It may not always be able to capture the intraday dynamics of the price discovery process in that sense. So there could be a disconnect, in certain cases between the domestic gold futures market and the spot market prices. In certain cases, we did observe that the domestic gold futures market and the international gold spot market did seem to indicate a disconnect in certain instances. Taking this relationship further, what we did was we estimated an impulse response function. Essentially, it tries to determine if a unit shock to the futures market returns and tries to estimate what would be the impact on the other market and vice versa. So what we found out was that a unit shock to the futures market returned or led to a positive response to the spot market in somewhere in the range of 0.5 to 0.75 units. In the other way around, we found that when a shock was introduced to the spot market, the futures market essentially just moved between 0 to 0.25. So we found that an impact of the futures market return was much higher on the spot rather than the other way around. A look at the variance decomposition results essentially talked about, wherein we look at the variance of both the series and see that what causes or what's the impact of the variance of, say, if I'm looking at the spot market, then I see the impact of the own lag returns of the spot on the current spot price, and well as the lag returns on the futures market on the current spot price. So we did find that the variation in the returns of the domestic spot market and international spot market were largely explained by the movements in the futures market. Further, as compared to the domestic spot, the variation in the international spot price had a larger role to play in explaining the variation in the domestic spot price. So that was something that was quite interesting to us. As a next step, we estimated the hedge ratio. This was done by looking at the residuals or the errors of the Vcm model and estimating the covariance of the spot and futures returns and the covariance of the and the variance of the errors of the futures market. And we found and we estimated the hedge ratio. So what we identified was on an average, we found that in certain cases, the hedge ratio ranged from 0.42 to 0.55. In case of the MCX spot, in case of the Reuters spot, it was somewhere around 0.45 to 0.55. But in case of the World Gold Council spot rate, we found that it was somewhere around 0.75 to 0.9. So when we looked at the hedge ratio results, it indicated that the futures market is a better tool for hedging the say the prices, which are products which have prices linked to the World Gold spot rate essentially here. And that's what we noticed there. So hedging effectiveness or variance reduction is the variance of the hedge portfolio versus the variance of the unhedged portfolio was somewhere around 30% of the variance of the portfolio was reduced in case of futures was introduced to the portfolio of domestic spot prices. But in case of international spot prices, that improved a bit more to about 50%, 48% as we see. So to summarize these results, what did we really find? We found that firstly, in certain cases, there isn't always a very strong long-run co-integrating relationship between the domestic and international spot price. That was one. We did, however, find a long-run co-integrating relationship between the futures market and the domestic spot market. That with the international spot market sometimes does have an impact. It has a weak relationship. This is when returns were considered. We do find that the daily price discovery process in case of India is ideally takes place in the futures market and not in the spot market. So people look to the futures market for price discovery. In case of any changes, the domestic spot prices do make a greater adjustment to the long run equilibrium level when the co-integration was estimated, and follows the lead of the futures market either in parts or in entirety. Futures market did not serve as a very effective hedging instrument for the domestic spot price movement, but it does play a slightly better role for hedging the variation in the international spot prices. Our policy implication possibly from this results could be that we need to have an organized spot market in place, possibly an improved mechanism of a platform where a spot price could be traded, and on a real-time basis availability as that picks up, it would lead to better price discovery in the spot market itself. So that is an important policy implication is what we have and we can think of here. So we have the VCM results presented before you, breaking them down into a long run and short run relationship, as well as a period wise analysis where we do find that there is a long run relationship in certain cases for the period 1 and period 2, but there was a disconnect when we looked at period 2, the period 1 and period 3, but there was a disconnect in terms of period 2. So so that is something that we had we observed from the data for looking at it for the past 10 years. This was in case of the MCX spot price. In case of the World Gold Council spot price, we did notice that in the long run, we didn't always really find a very strong permanent relationship there. But in the short run, yes, we do in certain cases. The weights essentially indicating the Bengal-Gonzalo weights. What we do is we look at the speed of adjustment parameters and then decide whether which variable does really pull the other variable towards this long run equilibrium trend, and that's what we found that the futures market does have an impact more prominently than the spot market. The variance here decomposition results for your perusal here. So that's it from my side. Thank you for the presentation. We are open to any questions from the audience as well as the panelists. Thank you.
Thank you, Emmanuel. Emmanuel, could you keep the conclusion slide?
Sure.
Yeah. Any questions from the audience? Thank you, Emmanuel, for a very interesting presentation.
Thank you. Thank you. Thank you so much.
Any questions? So Emmanuel, let me take the liberty of asking a question. I mean, these are documented facts, right? I mean, this is what you find in the data.
Yes, exactly.
What do you think is the reason for this lack of a a lack of a strong relationship between the futures and the international spot market?
So essentially, one of the things that the advantage of a futures market is that it's a organized, it's a exchange traded rate. It is something which is available on a real time basis. So rather than looking at something which is pulled in the beginning and the end of the day twice a day, I have a perspective of what the price could be on a real time basis, looking at the futures market. So that could be one possible reason why we do see price discovery happening in the futures market more often than not than the spot market. Additionally, the way the futures market is constructed is it's basically a price there. So that's one of the things we see there that's happening there. So that could be one of the reasons that the market plays the more influencing role in price discovery process there.
And what about this lack of relationship between the domestic and the international spot markets?
Manuel, I'll take that question. Manuel,
yes,
this is Dr. Golaknath. Yeah. See, when you look at the gold futures market in MCX or so on, let us look at few things. How the market is disconnected. Maybe, yeah, price discovery and all these things fine. But really, if I have to take a physical delivery of gold, and really I'm a gold trader, if I have to basically take physically gold delivery or something like that, if I'm a buyer of gold, that what kind of physical market, the way the physical market is structured in India, it's not basically if you want to buy something, he will take out a particular booklet and see. You don't really get the price at which the MCX decides the particular spot market price. The way we don't know what is the accountability of people who are giving the prices. At least future prices are quite they're traded prices and kind of things. But since your delivery percentage and all these things are so low, I don't know how do we connect that particular to the underlying market. That's basically one of the most important thing. And that's the basic reason why when you impose this particular tax and other things in the market, how the relationship broke out. When you have the link between the domestic and international prices is more disjointed because of the regulatory reasons. Okay, so that's the second period that we saw when we introduced that 80-20 and all kinds of things when India had these particular currency issues. So this is a kind of a fragile kind of a market. It's not a very well established, well developed market. Maybe we need to think about that Niti Aayog was working on this to set up a spot exchange kind of things that will possibly improve the efficiency of the spot and futures market, where I can really take delivery. Either look at the the stock market. Either I can take a delivery of the I can buy in the underlying market, Reliance, and the same exchange I can buy the futures also on Reliance. Those kind of things we'll possibly look at. That's what the we felt where we are lacking here.
Thank you, Dr. Golaknath. I think with the new bullion exchange coming in, I think that price discovery process might become a little better. Any comments from Som?
Yeah, thanks, Professor. It's excellent. First of all, I mean, I'm still absorbing what they have found out, but obviously the final point is very valid that the spot market will change it. I just wanted to go to the first point that was made, and also the penultimate one in this slide, that there is no strong relation between domestic and international spot prices. So does it, I mean, what that tells me, as I'm obviously, without going into the math, but if the international price goes up, you don't see equivalent jump in the Indian price. That's what I take out of this. Am I correct?
Exactly, yes. Because the tax structure and delivery structures of all these things, because of the demand and supply disjointed factors. It's not a demand and supply are not uniform factors. The Bombay fixing and Ahmedabad fixing are a little different.
This is extremely important. This is and the next one I come back is futures market does not serve as an efficient hedging instrument for domestic spot price movement, but plays a better role in hedging the variation in international gold spot returns. Yeah. So we are talking about the futures market in India, right?
Yeah.
Yes.
So what you're saying it is the futures price in India mirrors in terms of the variation the international gold price.
Exactly,
But
exactly. Yeah,
it does not, I mean, it does not link to a domestic spot price movement. So you may actually have a futures going up, you know, a month, 30-day futures or whatever.
Yes, the spot price may be
spot price is at discount.
Yes. Why this is so? Possibly because the futures trading, and you have large number of basically maybe people who are trading here, they have exposure to international markets and all these things, where I have to basically exert my views on this particular market rather than going and doing anything with the spot market, because spot market is a lot of regulations, controls, check delivery, all those kinds of things are there. So there, the efficiency in this particular futures market, that linking to the international one, immediately I can, take my views and, exert that views at this particular market. So that's from our point of view. Yes.
Excellent, excellent. Now I have no further questions. Very interesting, excellent presentation.
Thank you. This is a published paper, so we have already. It's about 1 year back we have published this.
Right.
Yeah. Thank you so much.
Thank you. Thank you so much.
And any other questions from the audience? There's some questions on the chat window.
I just have a comment. Thanks for paper. I had read through and quite surprised this is the first paper that came out with the point that how important is to come up with how
we cannot hear you. Can you? We are not able to hear you. Your voice is breaking.
Is it audible now?
Yes.
Yes.
Okay. Validate the importance of creating a new spot price mechanism. And that's actually opened up a new opportunity if you had to look at.
Yes.
I always mentioned that like 15 years derived from the traders as well as considered spot price, but that the derivatives price which is being
so this your voice is breaking.
Yeah, we're not able to hear you. Okay, what I understood from you, I mean, from whatever I could make out, just let me, please correct me. See, what is happening here? We can also improve the, regulatory governance structure. Okay, even the people who are giving the quotes, if you go to MCX website, you don't find much of the details about who are the people who are quoting. What is, basically if a person is quoting, what kind of, it may be, he may not be trading at all in spot. He may be, only his position in the futures market. Okay, so there has to be some amount of corporate regulatory governance which should be used for, taking a quote from somebody. Okay, like if you look at the, financial market side, in the financial benchmarks that the RBI has set up, the financial benchmarks India Limited, where there are regulatory governance standards for giving a quote. That's why all the international banks have stopped, because the regulatory structure of you need to have all kinds of records when you are giving a quote, because you are going to influence the price. Okay, so there are regulatory governance standards are extremely high. The transparency standards are extremely high. So because of that, the market has improved. So that's why we need to, even if you are not setting up a gold exchange, spot exchange, you need to work on governance standards. That's basically our, suggestion. So the Niti Aayog, we, we made some, basically kind of discussion with them, shared this particular paper with them, and they were happy about this.
Dr. Golak, this is Nagendra here. Can you hear me?
Yeah, Nagendra. How are you?
All well, God's grace, Golak. Golak, simple question.
Still in NSE? You are still in NSE?
Yeah, very much in NSE.
Okay, old timer.
Golak,
yeah, tell me.
Yeah, Golak, one simple question. See, when we talk about domestic spot prices, right?
Yes.
Did you basically look at the spot prices that were polled and displayed on the exchange website, or what is the source of your data?
Yeah, see, there are two ways. We try to, get in the data from the MCX, what they announced because of the poll prices, as well the people who give voluntarily some prices at Reuters. Third way, we contacted people like Muthoot and all the people who are in gold lending, business. So they also use a spot price to lend money against that. Then we found that when we compare all this data, all the, basically we talked to some gold traders also, and they received some kind of documents from their association, and that particular price also we compared. So what we found that the data this, that gold, the association provides that paper on which most of the retail, people sell to the retail customers, or when you go to a jewelry shop, or the data which is available from Muthoot in a disjointed manner, not we could not really get a good time series to create and establish that. So we don't have a choice. So what are the choice we had? We had only World Gold Council publishes some spot prices for India, as well as it is currency adjusted kind of things possibly they have to do. And then the Reuters publishes, it's a voluntary code, no corporate governance kind of things. And it's basically, voluntary people quote their rate. And second is, the third is the MCX polls, few traders. So, but not much of information is available about who is giving what kind of quotes. So what kind of corporate governance structures they're following. It may be that the guy has no exposure to the spot market, he only deals in futures market, and he may try to influence the future market prices, okay, by doing this. Because finally, your settlement will happen at the spot price at the expiration date. So that's basically our point. What is that limited one? Yes.
Okay,
I hope I have clarified you.
Golak, and one more thing. You said you looked at various sources, and can you also, just for the benefit of all the participants, can you also tell whether the prices were more or less on the same line, or you found
no, some differences, differences we found.
Yes. So that's exactly the point. Since the spot market is not as organized as an exchange futures.
It is obvious. We found thousands of rupees difference. It's not one or two.
That's exactly the point. So Som was asking us why, more clarity on the first summary point of yours. That's precisely the reason. Since the sources and the way in which the prices were given are, since they were not following a similar pattern, and obviously, your results could have been slightly skewed. This is my
No, that's also very, very good insight. You're right. It's anyway unorganized, and there is no good delivery. First of all, you can never be sure because each one knows what kind of delivery he normally gets in that area from those sources. So the prices automatically get adjusted for that. You're right, absolutely.
Thank you, sir. Thanks, Golak.
Yeah, thank you. It was very nice. Nagendra, thank you.
Thanks, Golak. God bless you.
Yeah, thank you.
Thank you. Any other questions from the audience? So there is actually a question for Dirk. Dirk, are you there? There is a question about. So there's a question about a shift, whether there's a shift from gold to silver, considering the silver prices outperforming gold prices.
We have not really looked at Sanket.
So this was a question for the previous speaker, for Professor Dirk Bar.
No, yeah.
Well, we haven't looked at that, right, Sanket? So we could. That's another good comment. I can just say that I don't know why there should be a shift to silver, but we could look into this. I think. What's the rationale for that question?
Yeah, Professor, if I may say, because the participants are not able to relay, and I know the person who asked the question, there is an industry view that which is seen by the industry, not a view, that when gold prices shoot up, silver is actually poor man's gold, they say. So people, instead of buying gold jewelry, they will move into silver jewelry, at least. And it is a reality of the situation. So the questioner was therefore asking, yes, you studied this relationship, but did you see then that people actually put more, the same amount of money probably was flowing into silver?
Yeah. I mean, in terms of the safe haven stuff, or what I've done whenever I look at silver, I mean, it's clear that silver is much more volatile, right? And that the long run relationship is clearly there, but there's also periods where the two kind of decouple. So I mean, there's theoretically, I've heard of this poor man's gold and stuff, but in crisis, it's not true. In general, that silver is not like usually doing the often generally following gold in during crisis periods, and in general it does. But yeah, I mean, for our paper, because I guess it's related to the paper, we could probably look into this if there's also not only the like a switch that jewelry in high income countries becomes less important, but that there's also a substitution from silver to gold or the other way around, right? So that would be an extension of it. Yeah.
Yeah, the issue is not an issue exactly. Of course, gold is the biggest material for jewelry, but with jewelry now expanding to other things also, like silver is there now, a little bit of platinum and others have come in. And of course, there is a whole host of diamonds things, which is also the domestic consumption is becoming very strong in the Eastern countries now. So the questions will naturally, as we study more and more about jewelry based on the data sources that we have today, Professor, you will see that questions will come up saying, yeah, people are not bought gold, but have we seen that they have moved on to something else? So
it's a good question. And I'm doing research currently on something related to this, but then it's not the question, do they go into silver or something else? But of course, it's you know that, or you're not surprised that it's Bitcoin or cryptocurrencies, right? I mean, because we often hear that Bitcoin is the new gold, and maybe that's just a narrative. But that's what I'm currently also doing and looking into this. Is there actually a switch? Because that has recently been claimed in the Financial Times. There were many reports that said people are starting to switch from gold to Bitcoin. I'm looking into this, and it's related to that question. Right?
Yeah, but
millennials.
Professor, even without your research, I will answer. People don't switch from Bitcoins to gold. If they buy Bitcoins, they will have to buy more gold.
Because they are complements.
Yeah? No, because that's a high risk, and this is a de-risking agent.
Okay.
Obviously, you need to do your research. I was just making a point in this. Clearly, we haven't seen evidence of people actually moving away from gold to Bitcoins. But clearly, Bitcoin is a different proposition, and it is obviously coming in of great interest. But the question was obviously related to not just silver. I just expanded even silver to say, did we see what happened to diamonds then? Even in the middle income and the high income countries. So because when people look at jewelry, we study only gold jewelry, but then the jewelry market itself is now becoming a little larger than just gold. So that was the question.